G'day, welcome to the Australian Property Podcast. I forgot where I was for a moment. I'm Pete Wargent. I forgot who I was as well. Pete Wargent from Alan Wargent Property Buyers. I'm here with Amy Lunardi, top buyer's agent down in Melbourne. Amy,
well, Pete, I'm going to stop you there because I'm also now apparently a social media influencer.
Oh, an upgrade.
And I think
or is
I'm
it? No, is
quit
that a downgrade? No, it's an upgrade. I don't know.
Well, yeah. I think I'm going to quit my day job because it's so interesting. I've inspected a couple of really amazing, beautiful properties recently, and I've put a bit of effort into making some reels. And Pete, it takes way longer than you would think it would to make a really nice video on Instagram. And I just put them out there, and they've gone crazy. I just think that there's such a niche on Instagram for people liking to perv on beautiful homes like I do.
I think there's a couple of accounts on there that focus on high-end property, especially in Sydney. I think people secretly like to see how the other half live. So you may have found a new niche for yourself there. What sort of areas of Melbourne would come into that picture?
Well, the last two that I've done have both been in Northcote, which have just been around the corner from me. So quite convenient because I kind of do this outside of my normal working hours. But then I'm actually planning on seeing a property later this week. So by the time this podcast comes out, I would have hopefully seen it and put it on my Instagram. And it's a $12 million home in Hawthorn. And, you know, there's plenty of properties like that in Melbourne, which are expensive. But I really like to see the ones which are unique in some way. And this one is, the interior design architect is just the most amazing. I just love them so much. They just use all of this bold color. It's really, really interesting. So I like to walk through properties like that. There was one I did a little while ago, which was basically a shell in Kew. It was this mansion and it was just almost gutted, but on this massive piece of land. It was all dilapidated. And I was like, I don't know if people will want to see this because it's not very sexy, but it did really well as well because these are the types of properties that sometimes people just, they don't get the chance to have a look inside. Yeah,
I think some of my favourite sort of properties in Sydney are the Seidler House, the Rose Seidler House up in the northern or the North Shore of Sydney is always one that's good. But I just love some of the old Federation homes and the arts and crafts style homes, places like Strathfield and Burwood. It's just such a beautiful design. I think sometimes when you go in some of those homes, I think, my kids would destroy this in seconds. But it's nice to dream about how life might be instead of the chaotic mess that I'm usually surrounded by. So
and it's not only the really expensive homes that like are popular when I post them. It's even the one that did well recently was this just beautiful, simple home in Coburg, and it was owned by an artist. So it wasn't renovated, but it was just beautifully presented. There was art all over the walls. It was just gorgeous. And I like to just look at unique properties and interesting properties. It's something that I'm really passionate about. So no, I'm not going to quit my day job though, Pete. Don't worry. We'll still do buyer advocacy and helping clients invest in property, which is what we're talking about today.
That's good to hear. I'll definitely keep an eye out for your Instagram reels in future as well. Not that I always do anyway, but I'll be especially keen to see that. So today we're talking about how to create a property investment brief, and there's effectively 6 key steps that we're going to work through today. Well, let's start right at the beginning then. Let's talk about strategy and the brief. I suppose before, they always say if you fail to plan, you've got a plan to fail. So where do you start out when you're thinking about a property investment brief? I suppose the first thing is to work out what's the big picture plan and why you're doing all this in the first place.
Well, exactly. And a lot of people skip this very important step and they go straight to the what. They say, I've heard that this area is booming, or I want to buy this type of property in this city. But we really need to start at the very beginning. And this is, by the way, Pete, not only when you're investing in property, but if you're buying a home, I always say start with the strategy. And it's kind of like a funnel. So think of it with the strategy being the top of the funnel, the very broad thing. And then we work down to the parameters around our brief and then our specific property brief. And that's what we're going to talk about today, how to work through this funnel. And the overall strategy, the best way to think about it is like the why, the when, the what, and the how. and this is investing or buying a home. And the why really needs to come first. Otherwise, there's no point in thinking about all of these other things. So with an investment strategy, it really is your big picture plan. It's thinking about your long-term goal. Why are you bothering doing this? You could take that money, Pete, and you could go and invest in the share market. You can go and spend it on a holiday. You can do other things which are either going to create wealth or give you a joy or give you some kind of other outcome. Why? What are you trying to achieve, and why property as well, which can be a really hard thing. And then it's also considering, well, you know, a lot of people think capital growth is the be-all, end-all, and yes, it is absolutely a goal. However, with capital growth comes income trade-offs. So generally, the higher capital growth properties will also cost you the most out of pocket in terms of negative gearing. And that's not going to be a realistic strategy for a lot of people. The cash flow is really important as well.
I think just going back to your Instagram Reels idea there, I think real estate is such a visual asset class sometimes. And when I think back over the years, the number of times people have sent me a message saying something like this, I've seen this amazing new townhouse. I think it's beautiful. And I think it'll be a great investment. What do you think? Or, you know, sometimes it might even be something as different as a restaurant. Or I've seen that they're building these new medical centres nearby. Should I buy one? And in every case, well, the answer is, well, maybe, but how do I really know? It depends really why you're doing it in the first place. What's the objective? What is your long-term goal? Is it to create an income for your retirement? Is it to sort of grow your net worth or your equity? In some cases, people are buying properties that they might want to live in the future. There's a lot of different reasons why, or different approaches that you could take to investing in property. But until you started thinking about why you're doing it in the first place and what your long-term goals are, it's very difficult. It's actually impossible for me to sort of comment on whether buying a specific property is the right way to go or not, because it really depends on what you're trying to achieve.
Absolutely. And thinking about this longer term strategy will also help you to determine whether you're wanting to buy quantity or quality, I guess is a good way to think about it. So for example, buying one or two more blue chip, strong capital growth type properties, or a larger portfolio which might be lower growth but higher yield. And it's also about considering diversification. So if you are buying several properties, is that within one state? Are you diversifying between different states or between different property classes within one area? And I've got all of my investment properties in Melbourne. That is just because I know Melbourne extremely well. Is that the right strategy? Maybe, maybe not. But it's also then considering things like exit strategies. At what point would it make sense to sell? And what would that look like? Do you need more liquidity in your asset classes? I'm going through this right now at the moment because I've had one of my investment properties with big repair issue. The tenant didn't report a leak for several months. It's got mold in it. I have to spend 20 grand on a new bathroom. It's really made me consider, well, do I sell this now or do I hold on to it? I never ran into it with an exit plan. So now it's a bit grey as to the timing when I sell it. But then it's also extra things like, how do I structure this loan correctly? What kind of professionals am I going to get involved? So considering all of these broader things is really important at the very beginning. This is the top of our funnel, and you can do this yourself or you can work with a financial planner. I do recommend doing that if you are considering investing at least in, multiple properties, or really wanting to have this big holistic plan where you also consider other asset classes, etc. Some financial planners, Pete, you might have come across them and are not as excited about property and sometimes might steer you away from property. So if you do want to invest in property, just find someone who is aligned with what you want to do and is open or pro property as well, because I have come across several in the past who, they just kind of try and steer their clients away from it for whatever reason they've got.
Well, back in the olden days, there were a lot of financial planners who were working on very much sort of a commission-based business, and therefore, if they weren't getting commission on properties, then why would they recommend properties? I think the industry has changed a lot over the years, and financial planning is by and large a fee-for-service model these days. But even still, as you said, there are some financial planners who just basically say, well, buy your own home, max out your super and put the rest in things like stocks and shares. And it's not to say it's bad advice, but it's not going to probably incorporate property and the potential leverage as an investor in property. That, you know, is something, if that's something you want to pursue, you need a financial planner who really is keen on the idea, but also understands the asset class. The quality versus quantity question's sort of an interesting one, isn't it? I think, you know, if I had to pick one, I'd probably say just focus on quality. But then, you know, I think I've learned as I've gone along. I think when I was younger, I used to think owning as many properties as possible would be the best thing. But then, just like you said,
like
I had
Monopoly.
a property. Yeah, and I think it's almost like a status thing when you're younger. But, you know, just like you said, I had a property down in Victoria, and I had all kinds of issues, including mold, coincidentally, leaking shower, and had this and the other. And in the end, I think some of those sort of mid-tier assets, they can be. You've got a bit more liquidity in the portfolio sometimes. If you need to sell something to maybe upgrade your home, well, it's a bit easier to let go of something that's a bit lower value and sort of a bit more, I suppose, sort of middling. So yeah, there's arguments either way. Obviously, diversification. If you're owning more sort of mid-tier properties, then you're spreading your risk around a bit more potentially. So yeah, there's pros and cons to that. And
it'll also depend, Pete, on your stage in life. So if you're older or getting closer to retirement, you've got a little bit more of a clearer map as to what the next 5 years or 10 years or 20 years might look like, because you are perhaps, not always, a bit more stable in where you are in that point in life. Maybe your kids have all finished school, they've moved out, and you know what your income's going to be for a little while. Versus when you're younger and there is so much more that changes, and that can be really where it's really hard. I'm sure you've heard of these companies who map out the next 30 years and say, okay, well, at year 5, we're going to buy a property with this yield and this purchase price. At year 10, we're going to do that. And if you're 25 or 30 years old, things are going to probably change for you quite dramatically. And they certainly did for me in comparison to when I first bought my first investment property as to now. I would have had to reassess that investment strategy basically every year. So the younger you are, and this is what I didn't necessarily have this 30-year plan. It was more a case of just sitting down and reassessing every year or two as to saying, where am I up to now? What does this look like? How does this change? But the most important thing here, which we need to focus on, is at least just considering this broader strategy. It doesn't have to be a year by year, this is exactly what I'm going to do, but just make sure you're thinking about all of these points before you start to now zone in to this next stage, which is starting to set the parameters of your property investment brief.
Yeah, it's funny you say that about the plan, because I, you know, broadly sort of had a 10-year plan, not just for property, for life strategy. And then, see, my daughter's 10 years old, so I can very easily work out where I was 10 years ago. But I thought, gee, the stuff that's changed over that 10 years, I've, you know, moved from, first I moved to Queensland, to Brisbane, then I moved up to Sunshine Coast. Then we had 2 kids really quickly that I wasn't necessarily expecting. And then, you know, we had family issues in the UK and I had to go over there. And I was thinking, hang on, none of this stuff was in my 10-year plan. So, of course, it's good to have like a goal and a North Star. But yeah, especially when you're younger, I guess, there's more uncertainty about which direction your life's going to go, career, relationships, who knows what else. So you got to have some flexibility within it as well. So, okay, we're moving on to the second key step, setting your brief parameters. So as you touched on right at the start, I guess those are things like, well, how much budget do you have? How much borrowing capacity? But also things like, well, how much cash flow can you sustain? I suppose, you know, some people have got no tolerance whatsoever for losing money on a property investment. Other people who are sort of doctors and surgeons and things might be very high income earners, and therefore they can just focus on capital growth and worry less about the cash flow. And then even within that, there's different ways to invest. A lot of people just don't want any involvement at all. They want to be very set and forget. But then other people who are in the trades or building, in the building sector, they might be really keen to do subdivisions and add value and renovate and that kind of thing. So I suppose setting the brief parameters, where do you start? I suppose you start with things like the borrowing capacity.
Yeah, well, that's step number one, because you might want to invest in property, but the bank's got to be able to
In
give you the money, Pete.
Yeah. Yeah.
And so it's then saying, okay, well, what's my borrowing capacity at the moment? And then is that actually going to get me what I want? There is no point in just saying, well, this is I can spend 400 or 600 or whatever it is. I'm just going to go and buy a property because that's all I can afford. Well, perhaps if you mapped that out differently and saved up a little bit more or reduced your debt or, earned more somehow, easier said than done, right? Then in a year or two, perhaps you could buy a more superior capital growth asset. Is that what you want? Is that aligned with your strategy? So borrowing capacity is one thing, but then also I've got a lot of clients will sometimes come to me, and I know this is a position of privilege, but they might say, oh, I've got a borrowing capacity of 2 mil or 3 mil or whatever it is. Well, we're not necessarily going to go out and buy a $3 million single investment property. We then need to potentially split that up or say, well, how much are you comfortable in spending on this particular property? And then the cash flow, I've got a cash flow calculator that I use, and you can build this out or you can work with a mortgage broker to say, well, what is this going to look like? Especially with the interest rates so high right now, Pete. I look at the calculators I'm doing for clients now versus 4 years ago, and the out-of-pockets have essentially doubled, if not more, for a lot of clients. So this is factoring in the rental income that comes in, that's your income, and then all of the expenses that go out. So that is your interest repayments, whether that's principal and interest or interest only. It's your property management fees, it's your maintenance, it's your body corporate fees, your rates, all of those things. And then at the very end, you'll be left with your out-of-pockets. Maybe if you could be positively geared. It's pretty rare to find those these days, but it could be positively geared where it's putting money into your pocket after all of that. Or otherwise it's negatively geared. So how much per month? Ideally, we're working off pre-tax figures here as well, Pete, because that's the out-of-pocket you're going to feel coming out every month, and your tax return at the end of the year, I say that's a bit of a bonus. Just stash that away. Are you comfortable with that? And also stress test it. What if rates do go back up again a couple of percent? What if you have 1 year where you've got a 10 grand bathroom you have to redo because the tenant didn't report the leak? So stress testing all of this and making sure you're really comfortable with the cash flow requirements. And then that's where you can have a play around to say, okay, well, if I increase the budget by X, what does that look like to my cash flows? If I target a lower yield property, what does that look like? Or, I need to have this amount of rent. So you can play around with that cash flow calculator. Then to start to say, okay, well, this is roughly how much I want to spend, and this is roughly how much yield I need, and out of pockets, you might say, oh, I'm buying into an apartment block with 10 grand OC fees. It's going to just completely erode that plan. And then we're just trying to figure out, okay, well, first of all, we've got our budget, then we've got our cash flow requirements. And like you said earlier then, Pete, layering on any extra preferences, like whether this is a low maintenance set and forget type property, or it's something you want to add value to, and in which case the yield's probably going to be lower because it's going to be more dated. So adding on all those layers, and that will then give the parameters of our property investment brief.
I think it's good to build in a bit of a buffer because, as you said, not only can interest rates change, but also your stage of life changes as well. I think looking back, when I was in my 20s, both my wife and I were working full-time and earning a high income, and therefore cash flow, we weren't really that sensitive to cash flow. You were dinks. Yeah, that's right. Well, you're playing life on easy mode. You don't necessarily realise it at the time, but because you've got other stresses, I suppose. But yeah. It's very easy to get mortgages. Wasn't really that sensitive to cash flow, and if there was a negative carry, well, save a bit of tax. It wasn't too bad. But then sort of later in the journey, when I went to become self-employed, well, the banks were a bit less keen to lend, and also you start feeling some of those negative cash flows as well. So yeah, and then as you said, interest rates will be up and down through the cycles if you're holding for the long term. So you need to factor in that as well. There'll be easy times and tougher times, and times when the economy's booming or in recession, and you can't sort of know all that ahead of time. So you need to build in a bit of a buffer. And I suppose you need to think about your preference for the style of investing as well.
It's all well and good to say, I love the idea of adding value, but is that something that you genuinely have the desire to do? Especially if you're investing interstate, how are you actually going to manage all of that? I tend to recommend if you are going to try and add some value, if it's not to try and just increase the yield straight away, which you might need and want to do, I often say, well, just wait till before you sell the property if you want to do a new kitchen, new bathroom, because at that point of time, then when you're selling it, you're commanding the most premium because you're selling it with a new kitchen and bathroom. If you do that now and you sell a property in 10 years, well, then you're selling it with a 10-year-old bathroom and kitchen, which may not have been cared for the tenant as well as you would have yourself. So really understanding, like, yes, it might be a great idea to add value in time, but is it practical? But then also on the flip side, if you want to set and forget low maintenance asset, which is relatively modern and new, well, that will sometimes come with a trade-off with capital growth, because within that purchase price, you're paying more of a premium for that newer property.
Well, trades are expensive at the moment, aren't they? I think adding value, materials, trades, and also it can be hard. Yaka, I don't know if you can see on the video, I've got no skin on the palm of my hands. I've got no skin here.
What have you done? What have you been...
Covered in paint.
Have you picked up a hammer on the weekend?
These soft middle-class hands are not used to ripping out fence posts that have been concreted into the core of the earth. So, yeah, look, you can add some value yourself, but that can be hard work as well, especially on a hot day. So, yes. And yeah, at the moment, almost everybody's finding that renovations, not only are they taking longer than they thought, but they're costing more, and in some cases much more. So yeah, try and be realistic on that side of things as well. So on the third step, putting together an example.
Actually, before we finish that one, Pete, I will mention also, because this is quite often a theme that I get with investors, is say, I also want something with a bit of land just so I can maybe subdivide it in the future. All well and good, but there's a couple of issues with that kind of strategy as well. First of all, if your budget is fixed, then in some cases it means that to get something that's subdividable, because just because a block is big doesn't mean it's subdividable. You might then need to compromise on the location, the distance from the city, the area, to get that block of land. Is that worthwhile? Because then from there, you've got risks around, first of all, planning regulations changing for the good or for the worse, which can happen quite often over the course of a decade or two. And then also, how do you actually plan on subdividing that property? Are you reliant on your future buyer being able to purchase that and have that subdivision appeal, and that's what you need for that property to grow? Or is there a way that you've planned in for that subdivision? Just say you want to build 2 townhouses on there. How are you affording that? Where can you afford a construction loan? Can you afford the holding costs? I've done it before. It is way more expensive than you think. Even to get to the point of just being ready to build is well over $100,000, consultant fees, all of those kind of things. So just bear in mind that buying something with more land for subdivision appeal isn't necessarily the best strategy.
Yeah,
all right, so we're in the middle.
we sort of talk about land to asset ratio and higher land value being good. But yeah, I mean, if you take that to its logical conclusion, you'd just buy land. You wouldn't be buying any building. But then, where's
land
the cash
value?
flow?
There's the key, Pete. Land value is more important than land size.
Yeah, it's a good
So
point.
I have a lot of inquiry come to me, and they say, I've got a budget of $700 to spend in Melbourne, but I want a house on a full block. I say, I would love to help you, but in the locations which I specifically work in, you can't buy that. So you have to go way further out. If your goal is just to buy a house because you think that land is more important, but you're compromising significantly on proximity to city and location and going into more gentrified areas, well, then that's a bit more of a speculative strategy. Just put a bit of thought into that. So anyway, we are at the middle point of our funnel, Pete, and now we're going to be at the bottom of the funnel. What's it called? Did you reckon at the bottom of a funnel's got a name, the pointy bit? Maybe the Germans would have a name for it.
It
They've
probably
got a name for everything.
Yeah, I was thinking. I mean that applies in every city. I was thinking in Brisbane, we used to get people come to us and say, "Look, I want a big 810 square meter block, subdividable," but then the budget's just nowhere near what you would need. And yes, you could buy it, but you'd be way down south of Cooper's Plains in areas where you wouldn't necessarily be wanting to invest at a time. I mean, maybe in the future as the area develops, but Yeah, so you've got to sort of work within the constraints of the budget you have. So yes, the bottom of the funnel, I don't know is the answer. So I'll stick that one into ChatGPT later on. But so we're looking at the third step, which is a clear brief. So we need to know the budget, what kind of rental yield we need. And I suppose, I think the most common brief that we get for investors is, I want something that's kind of easily rentable to maybe a young family, young professional couple today, but maybe it's got some future value add potential as well in terms of the condition. So it doesn't need to be perfect, but you do want something that's rentable normally.
Yeah, exactly. So the final thing that we're trying to end up with all of this, which is our investment property brief, has a couple of elements. And the first is the budget. So exactly how much do we want to spend on this property? The second is the location, so the specific suburbs that we're going to be looking in. And I'm going to elaborate on that in a moment because that's probably the hardest thing to figure out in this whole process. And then the third thing is the property characteristics. So, for example, I like to break this down into two categories, which is your non-negotiables and your bonuses. And for all of the home buyers listening to this, this might sound familiar because this is exactly what we want to create with our home buying brief as well: our budget, our locations, and our property characteristics. That's the brief. And the characteristics for a home buyer are going to be different, not always completely, but a bit different to an investor. So here's some examples of the non-negotiables that I have for my investor clients. For example, it needs to be on a quiet street, so not buying on main roads. It needs to be, if it's within a body corporate, a low density block. In most cases, it needs to be tenant ready. Maybe you might need to do paint, carpet, heating, cooling, but we need to be able to get a tenant in there pretty quickly. And for then extra things that you might decide is important for you based on your research of the demographics of that area. It could be things like off-street parking, a minimum number of bedrooms, and then X distance to the local train station. That's some examples of non-negotiables. And then you can have as many bonuses as you want. So north facing, a garage, an extra bathroom, a certain size backyard. Those are the three big elements of your property brief. And that's then your shopping list, which you say, this is exactly what I'm looking for. It will guide you for when you're searching online, for when you're speaking to the agents. Hopefully you won't veer off track because you've got this specific list in place. But we will talk about the locations here because a lot of people think, well, that's easier said than done. But where do I buy this investment property? Because you can technically go anywhere in Australia. It's very hard to narrow down, isn't it, Pete?
Well, it is. So if you've got that clear brief, I think I just jumped on realestate.com.au just to have a look there. So there's 181,276 properties on there. So if you've got a clear brief, so for example, if your budget, yeah, that's right. So the paradox of choice, I guess. But I guess if you know straight away you've got a budget of, let's say, 800,000, and you want a certain number of bedrooms, and you're probably going to spend at least 700,000. Well, straight away you're starting to pull together a filter that makes it pretty easy to sort of count properties in or out of your shortlist. So I think, now, as you said, the big one is going to be the location. I suppose they always say the location's a critical part of, oldest cliche in real estate, really, critical part of the investment, because that's the one thing you can never change. You could change the layout of the property, potentially, or you could add extra rooms, or you could change the color of the walls, but the location is, it's fixed. There's no changing that. So how do you go about the location selection process? I guess this is a whole separate step in its own right.
Yeah, it's challenging. So Owen and I did an episode a little while ago. I'll try and put it in the show notes, where we talked about data and research. You've got to start with deciding which state you want to buy in. That's probably the first thing. And I'd love to tell you, Pete, which state to go and look in. Or if a client called me up and said, this is what I want, I can say, okay, go to Perth, or Western Australia, that's the state, or go to Victoria. But I, as a buyer's agent, I'm really only working in my core area, which is Melbourne. So I don't have the magic solution of narrowing that down by state. That's on to you as an investor to decide where you want to go. You could talk to, and this is what I recommend sometimes for clients who are looking nationwide, go and talk to individual buyers agents within each state to say, okay, well, this is what I'm looking for. What type of properties and what areas within your place that you work could I consider? And then you can start comparing them, state by state. I do know that there's a lot of advocates who do, or investment type firms that do nationwide. And yeah, they can help you potentially work through data and figure out where to go. I do wonder though how effective they would be being able to then do the asset selection within those areas if they're not actually on the ground, local, talking to the agent, knowing the best streets, because you can go and identify Reservoir, for example, here in Melbourne as a great suburb to invest, but Reservoir is huge. And if you bought in the best street or the worst street in Reservoir, you're going to get a significantly different type of property and outcome. So starting off filtering by state, and then within the state, it sometimes then tends to be a lot easier, because if someone said to me, this is my brief, this is my budget cash flow requirements and kind of what I want, straight away I will be able to say, okay, well, within the area I work, which is quite a lot of suburbs within Metro Melbourne, these are the types of properties and areas that you could buy in. And I know that because I've been doing this for over a decade. I just know these things. But as an investor, you're not going to. So then you have to start off with this big list of suburbs and start searching through them all and saying, hey, which suburbs can I actually even buy in? And then from there, which are the best suburbs out of these ones where I think there's going to be growth? And that's going back to the previous research episode we did, Pete, talking about what are growth drivers? What has this suburb got going for it? Why are people with higher incomes moving into this area? Those are all things that take time and effort. And if this sounds like a lot of effort, if you're not working with an advocate, it is. You've got to put the effort in if you want to get the results.
Yeah, I think, I mean, as it turns out, or as it transpires, I think Victoria is probably the stage of the market cycle is probably the sort of the counter-cyclical investment at the moment. And also the Melbourne is the one capital city where with a relatively modest budget, you can still buy a house. I think in a lot of cities that's become much harder in recent years.
Hold on, what are you talking about modest budget though in a house? Because let's break this down.
Well, that's a good, yes. I mean, if you want to get more specific, look, we get loads of people come to us and say, I just want to buy a house. And then they're like, but my budget's like in the mid 600s. I'm like, well, you can do that in Queensland, Southeast Queensland, but realistically, you're really going to struggle. And then they tend to go to a buyer's agent who buys everywhere. And they very often seem to end up in suburban Melbourne. But to your point, I don't know. But nowhere near,
hold on, suburban Melbourne, if you're buying a house in the mid sixes, nowhere near the in a metro area. I don't know where you buy a house for mid sixes in Melbourne.
Well, I don't always follow up to see where people end up going when they don't engage with us. But I imagine it'll be 35Ks out of the CBD.
Way more, Pete.
Yeah,
even Ballarat. There's properties selling for mid sixes in Ballarat these days. Everything's sort of picked up, and Melbourne Metro certainly not within 30, 35 kilometres would you be looking at that. And this is where you need to start figuring out, is a house really what I want? If I want to be within Melbourne, within X kilometres from a city, or in Brisbane, does that then look like something like a townhouse or a villa unit? And then will that give me growth in different ways? Because instead of the land doing the heavy lifting for me, it's actually the location. And this is not specific advice, but I will just mention, I really love villa units. And if you're from Melbourne, you'll know what I'm talking about. And if you're not, maybe just you might want to Google this. But I really love buying villa units for not only home buyers, but for investors. And, ones in blue chip areas, which are going to appeal to downsizers in the future, to appeal to the baby boomers who love the single level, who then are coming from the big house and wanting an area which is really great, but they don't want the big land and the big yard anymore. They want a lock up and leave property. They want a garage. They don't want steps. So then thinking about all of these extra layers too, to say, okay, a house with land is not necessarily the solution here. What are my other options, and why could that be a good prospect in the future as well, considering demographics, not only now, but in the future of that area?
I actually had this exact dilemma myself in 2017, I think it was. And the banks weren't being very friendly at the time. My budget was like 485,000 in Brisbane. And I was like, we went and looked at some houses, but they were miles out. They were sort of in places like Deagon and further out. And obviously a very mixed bag of quality. And I talked it through with Heather and I said, you know what, let's just buy a unit in New Farm. Like we lived in New Farm. We understand it's blue chip area, and for a period there, houses were outperforming units quite significantly. But then, the cycle moves on, and the capital growth over 3 years was explosive. So yeah, and I think you could have got a very good result in suburbs as well. But I think as you said, a lot of advocates or buyers agencies, I don't know that they sort of necessarily going down to the detail of looking at the right streets, the right aspect. They probably don't even understand the local area, the agents, the process that well in a lot of cases. And that's where a genuine expert like yourself is really adding the value, because I think what I've found is that, I've got certain properties in my portfolio I would just never sell. They're so good. They're always performing well in good markets and bad. And then I've got other properties that are like, when the right time comes in the cycle, I could just flick that and maybe recycle the equity into something else. What you really want is an asset you can just hold forever if you want to or if you need to. So yeah, I think it's worth spending that extra time and energy and effort to get the really good ones.
Yeah, absolutely. So the whole point of this is to really work through the funnel. Always please start off at the very top. Don't just go launch straight into, your friend of a friend bought this one type of property in one location. Therefore, that's your strategy. Or you saw a medical center. I don't know who's buying medical centers these days, Pete, but not my clients. But, starting off at the top of that funnel and then working your way through down to the very bottom so that you've then got that brief and that shopping list. And you can stay on track. You can use it to go out and refine your searching to always come back to, and is there any point in going to see that property? Does it actually tick my boxes in my property brief? And then going out to the real estate agents and say, hey, this is what I'm after. Do you have anything off market, pre-market I should be aware of? Because right now, for example, I've bought pretty much all of my clients' properties throughout the winter off market, which is crazy. It's my normal percentage is about 30% buying off market, and it's been over 90% recently. So but if you don't have that shopping list, if you just go to an agent and say, hey, I'm looking for buy an investment property for around 500 grand, what do you have? They're not going to call you back. They're going to say, well, tell me exactly what you want. Bedrooms, bathrooms, which street, which area, give me the metrics so that I can give you the suitable options.
Okay, Amy, so we've built our final brief. So let's look at some final thoughts before you get out there on your property search. So I guess things can evolve as you go along, so you don't have to be too set in stone. But what else would you sort of throw in there as a final thought for somebody?
So I think the most important thing is to, not copy other people's strategies, not go onto the forums and someone saying this is a hotspot or this is what you should do. It always just needs to be focused on you at the start. And if you have no idea what you're doing, I think you should potentially consider engaging professionals. So a great little A team around you, starting off with a financial planner, got to get an accountant that's property savvy as well, a great mortgage broker, and then potentially a buyer's agent too. If you recognize, you've got gaps in your research or you have no time to do all of this or to do it properly, definitely consider engaging all of these professionals because this is a really big step. You're going to take. Property is a big cost. There's entry costs, exit costs. It's not a liquid asset. It's not like you can jump onto your apps in the afternoon, just buy a bunch of shares and then sell them the next day. It's quite a different big decision that you need to make. So certainly think getting a bit of professional help in this space is quite important.
Yeah, I think you're right. I think, as you said, it's not so easy. If you've committed to a property purchase, it's harder to unpick if you get it wrong. Much harder, in fact, than in, say, the stock market. So I think it's said a lot. But the first property you buy, in a lot of respects, could be the most important because it builds the foundations for everything to come after that. Just not just in terms of your borrowing capacity, but also your ability to move on to steps 2 and 3 and 4. And a lot of people, yes, they sort of get drawn into buying like an off the plan sort of apartment or something from a seminar, and it doesn't work out as planned, and then it's very, very difficult. You're kind of behind the 8 ball. So yeah, I think it's super important to get that first one as right as you can. I think there'll always be things you don't think about and things that work out differently, but you can be flexible with those, but just spend the time and effort to get the first one right, because it will really pay you dividends down the track.
Amazing. Thanks so much for your time, Pete. And I make sure you like and follow me on social media.
I certainly will, and I'll be in Melbourne for the AFL Grand Final. So if you see,
yeah, great.
Yeah, if you see me marauding around town in a Brisbane Lions Guernsey, yes, apologies in advance, but I'll be there for the whole week. So really looking forward to that.
Does that mean who's going to be in the grand final this year? I know nothing about football. What's your prediction?
It's too early to say. Yes, Brisbane have had a couple of goes in recent years, but it's very close this year. So hopefully not Collingwood, but it looks like Adelaide are probably the favourites, I would say.
Thanks, Pete. I'll see you next time. Bye.
Cheers. Thanks, Amy.
Thanks for watching this episode of the podcast. If you want to hear more from us, you can get daily videos and podcasts on Rask's YouTube channel, or if you want to enroll in a free course on investing, property, business, money, you name it, you can join over 34,000 other students and enroll in a free course on the Rask website. Simply head to www.rask.com.au and follow the prompts. Thanks for watching this Rask podcast.